G'day guys, welcome back to another update for gold and silver. Now they're both still bullish, but just watch for a bearish retrace due to divergence. Before we go any further, make sure you hit that like and subscribe button. Plus we'll include some back testing in terms of where you should enter and exit your trades. In terms of the outlook for today, March 20, record highs. Gold surpassed $3,000 per ounce, reaching a new high of $30.45, while silver climbed to $34.10 per ounce. In terms of safe haven demand, escalating geopolitical tensions, including the abrupt end of the Israel-Hamas ceasefire and renewed conflicts in Gaza, have driven investors towards precious metals. But trade uncertainties, US tariffs on steel, aluminium and other sectors have heightened fears of inflation and economic slowdown, bolstering demand for gold and silver as protective assets. Monetary policy outlook, anticipation of the Federal Reserve maintaining current interest rates in the 4.25 to 4.50 range supports non-yielding assets like gold and silver. Industrial demand, silver's extensive use in electronics and renewable energy sectors continues to underpin its price strength. So stay tuned to the end of the video for the backtesting trading parameters. So here we've got gold. We'll look at the long-term trends so on the monthly, the weekly and the daily. So on the monthly, it's still well above its moving averages, showing new highs. There's no CCI for it on the monthly. On the weekly, notice we've got again, the price is still rising, new highs on the price, but notice the CCI is declining. So lower highs on the CCI. Now that's a bearish divergence. Now I haven't drawn a target area or a retrace target yet because I want to see this start pulling back before we can start anticipating that. It's probably still a bit too early. This could keep rising, of course. So again, I'll keep an eye on that coming forward in the coming days. On the daily, again, we had a bearish divergence back here, a longer term bearish divergence. And that actually dropped and hit our initial target there in this smaller period. We've got another bearish divergence currently in play. So if I draw you can see there from that period there versus the CCI still declining. Now the CCI is rising, but it's still lower than the previous CCI. So that's another bearish divergence in a shorter time frame. But again, I'm not going to draw a target until we see this start to pull back. That's on the daily. If we go to the intraday or the 1 hour chart, we only trade in the direction of the daily, so you should take long trades on the 1 hour time frame. But notice on the 1 hour we've got a bearish divergence. Again, lower highs on the CCI versus higher highs on the price. Again, I'm not going to draw targets yet until that starts pulling back. But I'll just give you an indication. If we were to, let's assuming it starts pulling back from where it is at the moment, we're going to draw a Fibonacci to that low there, and we're going to aim for a target between that 23 and 38% level as a minimum retrace. Could go a lot further, of course, but that's our minimum retrace. So I'm not going to keep that in there for now until we see a bit of a pullback. Also, notice here on the daily, we've got this resistance at the previous resistance we had at 29.56. Now I'm going to delete that because there's no sign yet of a pullback yet, and that's still potentially rising. So as soon as I see that, I'll draw a new resistance area. So this is the back test for gold on the 1 hour time frame. So again, you trade in the direction of the higher time frame. So when the price breaks, or when the CCI breaks above that moving average band, and also the price is above the moving average band, that's where this starting point is indicated by. Up here, we've got the stop loss approach. So you enter one and you stop it out, and I'll give you the parameters at the end of the video in terms of how to trade the stop loss approach, and also the average down approach. So the stop loss approach made a few trades there, nice little profits, and in those few hours since the 13th of March, you would have made $340. I mean, it's currently live, $345. Whereas the average down approach, you would have made $797.98. So that's still in play. And we close it out when the CCI breaks into that, touches that moving average range. But do note as well, always be cautious, because notice here we've got new highs on the price, as I said, versus lower highs on the CCI. So that's a warning. Just be careful. If you're happy, you may want to take your profits. But as soon as you start seeing a pullback on the 1 hour time frame, you may want to close out your trade even before the daily hits its moving average range. So you can always try exit your trades early. So this is the silver chart on long-term trends on the monthly. You can see the price is well above the moving average band, and so is the CCI. Now they're both still bullish, so bullish movement on the monthly. On the weekly, the price is bullish, but notice the CCI has been dropping and declining, and that was a bearish divergence. And if we zoom into that for a moment, you can see there in that period there we had a bearish divergence. It dropped and hit our 23-38% target range. And how we measure that, we draw a Fibonacci from that high and we take it back to that point there, and that's at 23-38% Fibonacci range at minimum. You can see there it bounced right off that 38%, and bounced higher. And since then, the CCI is also now tracking in alignment with the price. Now, just be notice as well, the CCI is still declining and the price is rising, so that's potentially still a bearish divergence. If that price rises more than that previous high there, and that CCI is still declining or still lower, we're going to consider that a secondary bearish divergence on the weekly. So that's the weekly. On the daily, it's hit this key resistance up here at 34.87, and then this minor resistance here more recently at 34.24. And it's currently pulling back. You'll notice the CCI is also pulling back towards the moving average range. This is on the daily, but again, predominantly bullish movement on the daily. So if we go to the intraday chart, again, we take long trades only in accordance with this bullish move on the daily. But notice here, I've drawn this Fibonacci retrace on the hourly. We've got this bearish divergence versus higher highs on the price, hit that resistance on the 1 hour time frame. And that's all automatically already hit this 23.38% level. That's a Fibonacci range, that 23.38% level already been hit. But again, notice the CCI is making a bit of a move to the upside, but nothing too dramatic. And currently that's moving in line with the price. So again, if that price rises more than that previous resistance and the CCI continues to decline, that's going to be a secondary bearish divergence. So I'll keep an eye on that. So what I've got here is the back testing for the 1 hour time frame for silver, and I've got it marked here beginning when the CCI breaks above that moving average range and the price is also above the moving averages, and that's where on the close of our last video was made. So since then, the stop loss approach has been fluctuating up and down, but notice it's finishing off with $3,240, and the average down approach is finishing up with, so far, with 16,555. The baseline for each of these, I'm using 100,000 just to allow for a drop below the baseline. Look at a bit of a drawdown there. That actually fell below to about 85,000. So you've got to make sure you've got enough in the account to allow for a drawdown if you're going to trade the average down approach. Otherwise, a stop loss approach, you just would have closed it out with that little bit of a loss. But bottom line is the average down approach, had you traded that period on the daily here. Now it's coming ready to close out actually if you're going to follow that. So the idea is when it breaks into the moving average range, it doesn't matter what you're holding here, you close out the positions straight away. But again, similar to gold, notice here we had a bearish divergence versus high highs on the price, and the price is declining and so is the CCI. So you're always able to close out your position, and notice the profitability is dropping off as well. So you might be wise to close out your positions early and take your money off the table and be happy with the results you've given. Don't get greedy. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you've got a total of 3 contracts now running, add another 4, you've got a contract, 7 contracts running, add another 8, and then you've got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching and see you in next week's video.